We need to be building, in a sense, impact forests, where the focus is on the flows, the interactions between all of the businesses, where the complexity of this ecosystem of impact businesses is the same order of complexity as the complexity of the impact challenges we're trying to address.
Hey everybody, my name is Carsten Terp. I am the founder of a Danish impact media called Impact Insider, and you're watching the first episode in a series of conversations about economics and impact, and mainly why we need to understand economics in a new way if we are serious about pushing the world in the right direction as investors and as entrepreneurs. With me, I have someone who has strong opinions about this, Graham Boyd. He is the author of the book, The Ergodic Investor and Entrepeneur. Hi, Graham. Glad to have you here.
Hi, Carsten. It's wonderful to be with you in this conversation this morning.
And you're in Brussels at the moment, right?
Correct, on the northern edge of Brussels, and it's a fairly cold day outside, but still above zero, with some blue sky poking between some very light clouds. So it promises that my midday walk will be an enjoyable one.
And that actually is the exact same situation here in Copenhagen, where I am in our office building. So here's a short disclaimer. Graham, you believe in a concept called ergodicity economics, and honestly, I don't understand the concept fully. But what I do know is that it's a way of looking at economy, and it's a controversial way, meaning that mainstream economists will have plenty of reasons not to agree with you. So we're going to be addressing that as well. But Graham, let's get this show on the road. And just to give our viewers an idea of what to expect of this series and today's conversation, what is it that is so important for us to understand about money and impact?
Excellent. I love that question, Carsten. And to build on what you've just said, a lot of what I am doing is controversial in the sense that it's questioning a lot of the mainstream orthodoxy. Yeah, I may be right, I may be wrong, but why I'm doing this comes back to a question that was driving me 15 years ago when I decided to leave my job as a manager with Procter & Gamble. And the question I was asking myself then was, why is it that I'm in a company whose purpose is to improve the lives of the world's consumers? I have many colleagues who are passionately driven to make the world a better place, who are aware of climate change and all of our polycrises. Why is it that we're making so little progress versus the planetary thresholds, which is the frame of reference that actually matters? It doesn't help if we're taking one step forwards at the same time as we're sliding 10 steps backwards down a slippery slope. You know, we need to actually be moving forwards. And so I left asking myself the question of, well, impact is so obviously what we need. Why is it that impact seems to be so hard to bring to life? And whether you call it impact, triple bottom line, sustainability, regenerative, whatever adjective you're using, circular, all of them for me are different strategies, categories that are overlapping and complementary, that all center around the question of, we need to build an economy that enables life, human life, natural life, everything long term. Why is this so hard? And an image that often comes to mind is the image on a hot summer's day. You're in a room, the window is closed, and a fly has come in, and the fly is trying to get out the window, and it goes bang into the window. flies around a little bit dazed for a few minutes and then bang into the window again. And if the fly would only recognize that the window can't be moved through just by trying harder, banging its head against the window. Instead, the fly needs to figure out, how do I grab the handle, turn the handle, pull the window, and then I can fly through. So I've been asking myself for 15 years, what are our windows? What is it that we can't see, that we don't recognize, but because we keep banging against it and trying harder the old ways, we're not going to get through the window. And my PhD was in the area in particle physics of non-ergodic dynamics in particle physics. So I have experience with the question of ergodic versus non-ergodic that goes back to my early 20s, and I'm now almost 60. So this is 40 years of experience. And it's something where it's questioning the conventional assumptions deep inside economics and business. And the consequence of this is that we're not seeing clearly what money is and how it behaves over time. Because we're not seeing that clearly, the way we build businesses, run businesses, and invest in businesses creates needless losses, inefficiencies that lead to externalities and hold us back from creating a truly effective impact economy. And at the heart of this is in nature. Nature understands how natural capital behaves, not necessarily consciously, but through experience. And so nature strategies are actually the ones that we need to adopt in our economy. And then we will have, with ease, an economy that is truly delivering positive impact across all of the capitals. And I'll put a segue into where we're going. Part of what this leads us to is looking at competition and collaboration or cooperation, not as a compromise line, 100% of one, zero the other, or 100% zero the other way around, but rather competition and cooperation are two independent variables. And we can quite easily sit where nature often sits, at 80% competition and 80% cooperation. And that is the shift in thinking that ergodicity economics brings, and that I see as opening the window that is currently closed and blocking us from getting through into a truly effective impact world.
So, Graham, you said a lot of interesting things here, but one of them was we're banging our heads against the window all the time. Could you give me an example on how we're doing that in investment and in the way we think business today?
Yes. So one of the ways that we keep banging our heads against the window, if I think in impact investing, so in my book, The Ergodic Investor, one of the testimonials came from a woman in Brazil who's part of an impact investing firm. And what she wrote there, the pandemic gave me a powerful experience of how complex the world is and how interconnected everything is. And this is at the heart of it. If you look at nature, think of a forest. A forest is not 10,000 separate trees planted in their own separate pots. It's 10,000 trees planted in soil with interlocking root systems, interlocking mycelia, animals, microbes, everything traversing the entire forest. A forest is really not just the systems, but even more importantly, the interactions, the flows, the agency across the whole forest. And this is one of the windows we keep banging our heads against. By building businesses, by investing in businesses with a very narrow focus on just that business, on just one single output, we're shutting down all of the efficiencies and effectiveness sources that lie in this distinction between 10,000 trees in separate pots and a forest of 10,000 trees. We need to be building, in a sense, impact forests, where the focus is on the flows, the interactions between all of the businesses, where the complexity of this ecosystem of impact businesses is the same order of complexity as the complexity of the impact challenges we're trying to address, what you could call requisite complexity.
So why is it that we keep building businesses in pots instead of building this impact forest?
That leads straight to the heart of what ergodicity economics is all about. So the reason why we do that is because over the past century, as modern neoclassical economics has emerged, building off the old understanding of evolution and the old understandings in physics, we have a paradigm, a belief in economics that pure competition is the natural order of things, that pure competition is how nature works, and therefore pure competition is the ideal to strive for in business to solve all of our problems. And the lessons from evolution, for example, over the past few decades have shown very clearly. David Sloan Wilson is one of the pioneers in this area. I believe I have his book. I have his book somewhere here to the right. I don't see it immediately. David Sloan Wilson is one of the pioneers. And this research in evolution has shown very clearly that evolution happens at multiple levels, what's called multi-level selection, that within each level, there are high degrees of cooperation rather than competition. And so nature runs on this blend of cooperation and competition, where cooperation very specifically includes pooling of resources. So nature works that way. A key reason why economics has prized competition lies in where neoclassical economics learned its equations from 150 years ago, 300 years ago. Up until 150 years ago, all of physics, which is where neoclassical economics has sourced its roots from in terms of the equations, its understanding of physical processes, physicists didn't have the mathematics, the equations needed to distinguish between dynamics, processes, where the average over all scenarios was the same as a specific sequence of events along your path. Now, we know all too well as human beings that is simply not true for human life. It can make a huge difference to somebody's life if they win the lottery when they're 20 and can use that money to pay for a thorough education, to build a startup that becomes a unicorn versus they win the lottery when they are 95. Yeah. The order of events in our lives really matters. Equally, that's a different ordering of a beneficial event, although you can argue whether winning the lottery is beneficial or detrimental. Many people find it detrimental to their happiness. But equally, if you look at a disease, if somebody catches some illness that carries permanent consequences, and they catch that when they are 5 or when they are 95, if they catch it at 5, it changes their entire life path. When they catch it at 95, it changes the remaining few years of their life path. So this is at the heart of the ergodicity question. To put it in precise terms, if the path matters, then you're dealing with a non-ergodic world. If the path is irrelevant, if things can happen in any order, then the world is ergodic. So what I was saying is that a system is non-ergodic where things depend on the path. The history makes a significant difference. Now, what you're looking at here is this reddish pinkish area is the average model returns of the stock market. And what's hidden inside that average is a sequence for each individual company in the stock market as a whole of growth and loss periods. Now, if somebody is retiring and they retire over here in 1996, it looks as if their investment funds of over here, 3 million invested, will quite happily cover their retirement needs all the way through. They'll only exhaust their capital over here. And this is the kind of typical prediction you'll see when you're heading into retirement. You talk to your financial advisor and they will do all kinds of predictions and modeling. But inside those predictions and modeling is actually the assumption that the sequence doesn't matter. The history, the path is irrelevant, and that it's good enough to just take the average performance and use an extrapolation of the average to predict the outcome. But now let's look at what might actually happen. This green line is the path of that retiree's funds when the sequence of events is the worst case of what actually happened on the stock market. And there you see their funds are depleted when they're 79. And they've now run out of money for the rest of their lives. They have nothing left. And the blue case is the path that their money takes if the highly positive returns happen very early and the losses happen late. And so you can see here, this makes a huge difference to an individual retiree's life, which order the events on the stock market actually happen. Now, the same thing is going to happen if you're trying to run a business. Let's say you're investing in an impact business. Your impact business is going to have a path through time, a sequence of events that are beneficial and detrimental. And it makes a huge difference to that business if there's a run of detrimental events early in its path, or only late in its path. If those detrimental events happen early, that business can very easily go bankrupt, or even if it doesn't go bankrupt, seriously underperform versus its targets, not because there's anything wrong with the business, but simply because it had a run of unpredictable, uncontrollable, detrimental events dominating its early path. And this is at the heart of ergodicity economics, is this recognition that almost everything that happens in life and hence in business, the path matters, the sequence of events matters, and we need to build differently, run differently if we're in a world where the sequence of events makes a huge difference. And I can give you one more example of that, but maybe you want to come in with a question at this point.
Yes, because I'm very curious about how should we respond to this? I mean, as investors, for instance, because we could invest in a business and it could follow the detrimental path and go bankrupt in 5 years without having reached any impact at all.
Yes, yes. Perfect question. And that's a question I deal with extensively in my book, The Ergodic Investor and Entrepeneur. Also, I deal with that in the other book I wrote with Jack Reardon. By the way, Jack Reardon is my co-author for both books. He's an economics professor in the US. So, to answer your question of how should we deal with this, we, as I said, just need to look at nature. All of nature is non-ergodic. And so the strategies nature has developed ever since life began on Earth, what is it, 3.5 billion years ago, are well tried and tested strategies to thrive in a non-ergodic world. And if you think about the fact that 99% of the species that have ever lived on Earth are now extinct, Earth is not that friendly towards life. In fact, Earth can be downright hostile towards life. Volcanoes go off and completely destroy all life on an island. Floods come in and completely wipe out all life. Fires, etc. And yet life remains stubbornly persistent and manages to thrive even in the face of all of this hostility. So life clearly knows how to run an impact economy. I think of nature as an economy. It's a set of businesses, each individual species, that are in trade with each other. They exchange capitals. So in many ways, we can think of nature as an economy where the primary capital is energy, and the primary currencies conveying that energy are carbohydrates, fats, and proteins. If you think of nature in that way, nature is an economy. Each individual living entity is a business. And it's a profitable business, and it's a highly positive impact business. It runs net positive, massively net positive. And at the heart of how it does that, it comes back to cooperation. Nature works in a way that is a blend of, yes, lots of competition. There are aspects of nature that are definitely red in tooth and claw. Think of a shark in a marine ecosystem. There's a lot of red there, and there are a lot of sharp teeth there. And yet at the same time, nature is highly cooperative. There is a lot of pooling of resources in nature. The research into how a forest actually works shows quite clearly that trees and the mycelia of mushrooms transport nutrients across the entire forest, and they have a communication system that recognizes where there is an abundance of nutrients and where there is a scarcity of nutrients and there's an active transport of nutrients from one place to another. So active cooperation, a recognition that a forest has a far better chance of thriving than a single tree by itself. And so the forest is working at that sweet spot of enough cooperation to maintain the health of the entire forest, to some extent at the expense of individual trees, and enough competition to maintain viability in the face of a constantly changing environment. And you even see this. Recent research suggests that an old tree recognizes when a neighboring younger tree is one of their offspring or offspring of another tree, and they will preferentially support their offspring rather than the other offspring. So there's a variation. You cooperate more with those entities, species, living beings that are in some sense close to you, in a tighter relationship. The cooperation is higher, the competition is lower. And at the other end, I'll come back to the shark. What's become really clear is that if you remove sharks from a natural ecosystem, or any apex predator gets removed from the ecosystem, the entire ecosystem suffers. So a marine ecosystem where sharks are removed, the entire ecosystem loses its capacity to thrive. And that suggests very clearly that whilst sharks may be in a competitive relationship with a dugong, the sea cow that they're eating, at the higher level of the ecosystem as a whole, nature doesn't care. Nature only looks for what works, and the shark plays a role in driving cooperation for the whole ecosystem. It does a job of pooling resources, pooling capitals across the ecosystem. That's at the heart of where we need to go. We need to build businesses that are designed to cooperate with other businesses at an ecosystem level, invest in an entire ecosystem that has some level of cooperation, an appropriate level. And by cooperation, I mean hard cooperation as well as soft cooperation, actually pooling, for example, 10, 15% of your profit each month goes into a central pool that is shared out again across all of the members of the ecosystem. And what that does is it restores ergodicity to a non-ergodic ecosystem. And by restoring ergodicity, you get closer to the maximum possible growth rate.
So briefly, this nature-based impact economy that you're talking about, you're not canceling competition. You're saying, let's turn up the volume when it comes to collaboration and see this entire economy as an ecosystem.
Yes, exactly. And even more perhaps paradoxically, where we sit at the moment, we have pure competition, but then we put competition into handcuffs with all kinds of laws and regulations and restraints to get something that is working moderately badly. And so actually what I would say is we want to turn up the volume on cooperation massively. That will also enable us to turn up the volume on competition, but we'll now be having a healthy blend of high competition and high collaboration, the way nature runs. And that will give us an ecosystem that thrives far better than we have today. And so in that sense, what I'm saying is also, if we think of this from an impact investor perspective, many investors are running on a 95% balance. 95% of their money is invested in the traditional economy, 5% goes into impact, and they need to run at this 95-5 balance to maintain their wealth so that they can keep putting money into impact. What I'm saying enables us to get to 100% of money invested in impact business, because it's also a fully viable investment from the purely financial perspective. And imagine what we could do in impact investment if all investment with an impact mindset was going into impact because that was financially better. Just how much impact would we be delivering? And what would then happen to, say, the pension funds when they see these impact investments outperforming their old school investments financially? The pension funds will start to shift all of their investments into impact investment because it performs financially. And this will be a virtuous spiral in that more and more money over the next decades is needing to go into remedial actions to fix all of the harm caused by the externalities of our current zero cooperation, only competition strategy. And that is going to reduce significantly people's lives, in particular, let's say, pensioners. So there is actually a real motivation for pension funds, if they think holistically about what they're there for, to invest in businesses that are improving the quality of life as a whole, i.e. impact investment, and delivering enough return on investment to fund the pensions.
Graham, this all sounds great, but if I were a mainstream economist, I would raise some criticism when it comes to ergodicity economics. For instance, I think they would say that there's no evidence that economy actually works this way. What is the criticism that you often meet?
Yes. So in terms of the question of does the economy behave this way, I look at this as a question of pure mathematics rather than anything else. So we just need to look at how randomness works in business. It's a purely mathematical question. And most business processes are multiplicative. In other words, we're talking about compound dynamics. Most people are familiar with compound interest. If you think of a typical business, many of its expenses, many of its risks are a proportion of the current value of the business. For example, its current free cash flow or accumulated reserves, the size of the business as it is now. If I think of my old company, Procter & Gamble, we were always targeting single to low double-digit growth rates. So we wanted to continue growing at, say, 8% per annum, regardless of how big the business was the previous year. And as soon as you have compound growth rate, as soon as you're multiplying today the number that you had yesterday, path matters. Non-ergodicity matters. We see that in simple things like, let me take another example, poker. Poker is played professionally. Professional poker players fully understand that the sequence of bets matters. You might be a really good poker player, but you have a run of cards that you can't play as a winning hand. And so you get kicked out of the game because you simply run out of reserves. Poker players have strategies to deal with that. One of the strategies is called the Kelly criterion, where poker players reduce the amount that they're betting below what they would logically bet in order to preserve their capital reserves so they can stay in the game. Even more interestingly, poker players cooperate. Professional poker players are often part of an expected value pool where if they win greater than their expected winnings, they put the excess into a pool, and that pool is shared out across all of the poker players. And that level of cooperation within the members of the pooling mechanism enables that all of the members to stay in the game for longer. So in that sense, the response to the question is really, there are two levels here. The foundation level is pure mathematics. Does the path matter in the dynamics? And capital dynamics in multiplicative processes with randomness, the path matters. Nassim Taleb focuses on the extreme version of this in his book around black swans and white swans, where random events that kick you out of the game, that's an example of non-ergodicity at play in the economy. And if there's a random event that kicks you out of the game, it doesn't matter what the potential hypothetical average performance of the company would have been. Once you're kicked out of the game, you can't keep going. You can't access anything else. So there's that pure mathematical question. And I would say that that can't be argued away with words. Where I see room for lots more research, lots more discussion is the question of which processes are truly non-ergodic, what is the impact that they have on the economy, and what are the optimum strategies to minimize the detrimental consequences of non-ergodic dynamics. You know, those are the three questions where there's lots more research needed.
So basically, the criticism that you meet, you find that that doesn't have to be taken too seriously, but there is some room for improvement and for new knowledge.
Yes.
Okay.
Yeah, I would say, and keep in mind, my background is physics. If you look at physics 150 plus years ago, physics was blind to the non-ergodic dynamics in physical processes. It was only about 150 years ago that recognition began coming into physics. And it took quite a few decades of really fundamental research before physicists began to really understand what this meant. And there was initially a lot of skepticism of, well, is this a real phenomenon? And if it is real, does it really matter? Can't we just safely ignore non-ergodic dynamics the way that we always have? And so it took time to do the research, to get enough understanding to make it really clear to everybody, when is it critical that we recognize non-ergodic dynamics? When can we safely neglect it? And when are the dynamics completely ergodic?
Graham, I think this is probably what we have time for today. But we have a new conversation coming up in a couple of weeks, and I was wondering maybe we should explore this ecosystem, this impact ecosystem, and break it down a little bit in our next conversation. How do you feel about that?
I love the sound of that. Let's dive into this impact ecosystem question, break it down, and by breaking it down, look at how do we rebuild impact ecosystems to be far more impactful for the same amount of money.
That's a plan. Graham, thank you so much for being with me today.
Wonderful, Carsten. And likewise, thank you so much for this opportunity to talk about one of my favorite topics.
And thank you everybody for watching. Hopefully we'll see you in our next episode. Bye for now.
I look forward to that. Thanks, everyone. Bye for now.